Building confidence is real estate set to gain. Welcome to Market Insight. I'm David Pollard. Jerome Powell not in a hurry to lower rates. Such was the message drawn from comments by the Fed chief on Monday as he sought to manage down hopes for a second bumper rate cut. But homeowners may already be feeling the positives of a first bumper cut, with the recent drop in mortgage rates translating into roughly $300 a month of savings on the purchase of a $300,000 home compared to a month ago. Well, for his take on all that, I'm joined by Ross Gerber, President and CEO of Gerber Kawasaki. Welcome, Ross. Many thanks for joining us. The tone of the housing market has been a bit brighter of late. How quickly and how directly will Fed rate cuts feed into the US real estate market?
Well, in some ways, it's feeding in really rapidly. In other ways, it's going to take time. And, what we're seeing with the Fed now actually lowering short-term rates, because we had an inverted yield curve, mortgage rates were really high. Whether you had a short loan or a long loan, it was still a 6 or 7% rate, which is where it is today. But now with the short end coming down, what it does is it allows people to buy ARM mortgages or interest-only mortgages with shorter durations like 5, 7, and 10 years. And now those rates are coming down into the fives. So what we expect over the next year is we'll see mortgage rates at 5% or so in America, or maybe lower, depending on the economy. And that will spur a whole new renaissance sort of buyers that have been sitting around not doing anything for years because rates are so high, it's literally impossible to buy a home in America. So this is going to bode very well for not only real estate, but all the ancillary businesses that benefit from when people buy homes.
Well, the US housing market is split, of course, between new home sales and existing home sales. For the first of those, home builder sentiment did improve in September for the first time in a few months, but analysts talk of a raft of challenges there, particularly around labour costs and availability and cost of materials. What's your take on home builders at the moment?
Well, we own Lennar in my fund, GK, and at my firm, and the home builders are still having pretty good margins, but all the issues you brought up are legitimate, along with higher rates causing them to have to add incentives to help buyers be able to afford their homes. So with lower rates, it allows them to sort of take away the need for these incentives, increasing their margins, which will help offset some of those costs. Now, in general, construction costs have mitigated considerably from a couple of years ago. And now with a slower economy that's still growing, the demand for construction is still pretty high, but it's much lower than it was just 2 or 3 years ago. So this is sort of an ideal environment for the Home Depots and just owning good assets in especially residential. Commercial real estate is very troubled, and we're staying away from that area of real estate. So I want to be very specific. I'm talking about residential single-family homes, I think, are one of the best investments you can make today.
Okay. And in the meantime, an estimated 86% of existing homeowners are locked into mortgage rates below 6%. You say rates are now dipping into the 5% sort of territory, but are they going to have to fall quite a lot further before we see much stimulus on that section of the market?
So this is going to be an interesting thing as rates come down, is what happens to all the people with the 2.5% and 3% rates that are in houses that maybe are too small. We were talking about the 5Ds, the things that make you sell your home, like death or divorce or losing your job. And so there are certain reasons that people just have to sell their homes, but it's very, very hard to look at buying a more expensive home with twice the interest rate that you're currently paying when you already own a home today. So I think it's going to be an interesting thing as loans mature and people are forced to move. So they'll have a certain amount of supply increase, but then also many people are probably not going to move just because until those loans mature, they have a deal that they'll never see again. So it's an interesting time, but it really bodes well for real estate, especially residential, and prices continuing to rise.
So tell us a little bit more about where you can invest in this sector. You mentioned Home Depot and the other home improver retailers and 1 or 2 home builders. Where do you see value?
Well, another place that we're investing is in REITs. REITs give you access to the income stream of real estate. And because we expect rates to be much lower in the next 5 years. So, as economies slow, and we're seeing it in Europe, particularly quickly, the economies have slowed, but we're going to see it here in the United States in the next couple of years as the economy slows. These rates still will work their way through for many, many more years to come. And it will continue with demographics and AI and technology to force prices down and slow the economy. So, I think the real reality is if you own real estate that's paying you 5% or above, there's a lot of upside. One way we're playing this is in VICI properties, or what we call Vici properties, which is all the hotels and casinos in Vegas. And so these are very solid assets that pay rent every month, every quarter on time, and it pays about a 5% dividend, and it's growing over time, and they're just wonderful assets to own. So we like REITs of really strong performing assets with yields over 4.5 or 5%, where we think yields like that are going to be really hard to find in the next couple of years.
And finally, this is a week which is dense with labour market reports. How is the jobs market looking? Is it strong enough to keep the housing market strong?
And I think this is where we just don't know what will happen in the next, 6 months to a year with labor. I suspect the economy is stronger than what people, expect. And because rates are now moving down, it encourages people to spend, and they'll have more money in their pockets as, credit card rates, home equity lines, all these rates go down. It saves me money. I have a home equity line. So just for me, the rates are saving $300 a month right away. And so that money translates into higher spending. So that supports the job market over time. But the real, momentum is down now. So, I think that's where it gets tricky. Can the Fed really, thread the needle with rates and keep employment, strong enough in the economy, but without creating more inflation? And I think that there's a pretty high likelihood this will happen because the underlying strength of the economy is pretty high. And so despite the Fed, kind of jiggling around, not sure what they're doing, they have been fortunate enough that the U.S. consumer is strong and jobs are still strong and the economy is still strong and demand is still strong. So with lower rates picking up real estate, that will very much help the job picture.
Okay, Ross Gerber of Gerber Kawasaki, many thanks for sharing those thoughts with us today. That is Market Insight. We have more videos on Reuters.com.